Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have investor Kevin O'Leary to discuss the current investing environment through the lens of VC investors and making investing accessible to all via crowdfunding. Kevin, it is great to have you with us. Welcome to Trade Talks.
Thank you so much.
You got it. Let's talk about the current state of VC and startup funding. We went through a massive valuation reset. What are your thoughts as it stands right now?
The challenge that venture funds have, including private equity funds and hedge funds that have dabbled in venture investing as well, we've had a bull market now for almost a decade, and then we've had this massive repricing. And so most funds are in their fifth, sixth, seventh year, and they've got a wide range of investments on the books now. Now they have the difficult decision of deciding which ones to keep alive, because most of these, in many cases, are burning cash, and which ones to let go of, because you can't fund everything that's losing money in a portfolio. It was easy to continue raising capital if you had growth in revenue, but the market's changed rather radically in the last 90 days, and we're in a situation where the only thing that matters today is cash flow. So if you're not cash flowing and you're just growing at any expense, that's not going to work in terms of getting refinanced. So we're in a difficult position right now.
Yeah, Kevin, I would agree. And as we think about it moving forward, do you think that investor behavior has shifted permanently as we think about what valuations look like, how we're assigning multiples without the massive amounts of liquidity that's been in the system? Do you think investors are just going to be more discerning?
They are, actually. They're going to be more concerned of return of capital than return on capital. And a lot of these situations don't have any runway for profitability yet. It's not clear. Many of the situations, particularly in consumer goods and services or in fintech, they don't have a way to make money acquiring customers yet, because the customer acquisition costs are higher than the lifetime value. The assumption was always you could turn off the spigot of customer acquisition and start flowing cash, but then you have no growth. So it's which evil do you want to deal with? And a lot of the companies are struggling with that right now, trying to figure out, okay, really what it boils down to now in our shop's deal flow is we look at how many months of cash they have left till they're zero. And so what's the burn rate? Do they have more than 12 months, 12 to 18, 24 months, whatever it is? And for many of these young entrepreneurs that are great founders, they've never been in a situation where they didn't have access to cash. Now we're going to find out who really can execute, because a lot of these companies are on their way to zero.
And Kevin, it's interesting, as the average investor, we see you on Shark Tank all the time making these decisions in addition to what you do for your day-to-day job. I want to learn more about StartEngine. This is a crowdsourcing platform that allows a regular investor to get involved in some of these deals. Tell me more about that, democratizing that type of access to everyday investors.
Well, what really attracted me to StartEngine, and I got involved years ago now, is that Howard Marks, first of all, is a contemporary of mine. He started Activision the same time I was doing the learning company. So we've known each other for decades. And he's always been managing companies, always been a venture capitalist. But what he saw in the Jobs Act years ago was the opportunity to compete with traditional VC funds or private equity or hedge funds. Because whenever you go and raise venture capital, you always end up, in most cases, with a preference share that's senior to your rights as a founder. And that's been the case for decades, since the 50s. You know, ratchets, preference exits, all kinds of stuff that the traditional or founding shareholders don't get that the VCs want. And on top of that, they have a time schedule because their funds are generally only 5 to 7 years. What Howard saw was an opportunity to tap equity crowdfunding where you could sell equity to your customers that don't have a time track record. They don't care. They want to align themselves with a company whose goods and services they use, and they'd like to own some equity in it. And so equity crowdfunding was born. And initially, the biggest rap against it was the maximum you could raise was $1,070,000. That all changed when Howard kept pushing with the regulators to get to $5 million, which you can do now in a Series A. So you're completely competitive with traditional venture capitalists, except you have a really interesting attribute in terms of the features of what you're selling. You can sell the same class of share that you founded as a founder to new shareholders. So it's a level playing field. Nobody has any supreme rights. Nobody's got special preference. There's no extra cost in terms of the preference. And so at the end of the day, it's competitive in cost, but much better if you're a founder and you can align yourselves with your customers and shareholders in a way that's never been possible before.
What do the demographics look like on SmartEngine?
Well, it's really, if you look at the platform, what's brilliant about it is it's got over 250,000 investors there. So you bring your deal, you show it, and the whole idea is that you go after your customers. And sometimes they only put up 200, maybe 2,000, maybe $1,000. But if you get thousands of them investing, you get a very sticky shareholder base that's aligned with your vision of where you want to take the company, which is what has made it so popular and ever growing, because it's word of mouth in this space. After all, it is the crowd. They talk about this, and every month there's another successful company raising between $1 and $5 million, and for terms that are very attractive to everybody involved. So the demographic tends to be younger. They're more digital. They're more hip, sort of in the mid-30s. And very much wide open to new ways of financing, because this is not your traditional venture capital funding. It's highly competitive to that, right, and a brand new asset class that is simply not going to go away. It's just going to continue to grow faster than any other.
So you don't have restrictions of being an accredited investor, and these investors, while young, do they understand the liquidity profiles and so forth of this kind of investing?
Yes, it's very transparent. All of that information is provided on the website. But, like any other investment, there's always risks. So when I tell people to get involved in venture, just like on Shark Tank, I don't do one deal. I'll do 15 because I never know what's going to work. And generally, maybe 2 or 3 out of 10 become huge winners and pay for all your other mistakes. Same thing on StartEngine. Don't just buy one deal, buy 5 or 7 or 8 or 10 and get a portfolio of things that you like, you understand, and that interest you. Because all of the companies are totally transparent. You can see them all there, all the information and the price and the terms and everything about what you're buying.
All right, Kevin, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Take care. Bye-bye.